I will cover a story of 7 men who were among the richest and most powerful men in the world. According to author and financial historian G. Edward Griffin, these 7 men controlled about a fourth of the world's wealth. That would amount to trillions of dollars today. Can you imagine that amount of wealth concentrated in 7 families? But it doesn't stop there. These men were drunk on their own lust and craving for even more wealth and more power. To achieve this, they orchestrated a secret meeting in a secret location 1,000 miles away from where they lived, where others would not easily recognize them. The purpose of this secret meeting was to create a structure to facilitate their plan to create this level of more wealth and more power. Then they exported this structure to other countries throughout the world, ensuring their grip on this additional money and power they planned to amass. Today, I will show you how this masterful scheme was accomplished and how their plan eventually gave control of our currency and banking system to the Rothschild family of Europe. Yes, the Rothschild family. My name is Ben Reppond. Today is June 14, 2022. Thanks for watching my YouTube broadcast. You're about to see how the world's global elites came into power and how the system they conceived is making their private foundations even wealthier at the expense of those in the working middle class who are not invited to belong to their club. If you wonder why the world is so upside down and that the whole system seems rigged against the average person, this story will explain how this all came about. Let's start by going back to our founding fathers and what they envisioned and what they warned us against. Thomas Jefferson said, "I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around the banks will deprive the people of all property until their children wake up homeless on the continent their fathers conquered." Thomas Jefferson, 1802. I will begin with the backstory. According to historian Donald Watkins, in 1791, the Rothschild family of England gained control over America's money supply through Alexander Hamilton, the family's agent in George Washington's cabinet. When the family established a central bank in the U.S. named the First Bank of the United States, which received a 20-year charter from Congress in 1791. Pictured here are a few of their residences around the world. There are many more, but I am just showing 6. I think you get the point. When Congress refused to renew the charter of 1812, the Rothschilds threatened the U.S. with a most dangerous war with Britain. The U.S. stood firm. Following through on their threat, a second war broke out between the U.S. and Britain. We know it as the War of 1812. The British war effort was financed by the Rothschilds. When the war ended in 1815, U.S. finances were in shambles. In 1832, President Andrew Jackson led a successful effort by Congress to retake control of America's money supply from the Rothschilds by refusing to renew the charter for the Second Bank of America. Not until 1913 would the Rothschilds be able to set up their third central bank in America. In the meantime, beginning in 1875, the Rothschilds, acting through their New York banking partner Jacob Schiff at the banking house of Kuhn Loeb and Company, financed John D. Rockefeller's Standard Oil Company, Edward Harriman's railroad empire, and Andrew Carnegie's steel empire using Rothschild money. In 1913, the Rothschilds established their last and current central bank in America. It is not a bank, but a series of 12 banks that are part of the Federal Reserve System. This banking system regulates and controls America's money supply and monetary policies. Even though the Federal Reserve is overseen by a board of governors appointed by the President of the United States, the bank's real control still resides with the Rothschild family, according to Watkins. Their plan was to set up a structure that would make them and their families even wealthier and more powerful, of course, at the expense of those who were not in this exclusive club of the world's most elite families. I will tell you who these 7 men were and how this plan unfolded, how the sinking of the Titanic actually has ties to this story, and how this banking system is affecting us today. These wealthy New York bankers met on privately owned Jekyll Island at the end of November 1910 for this secret meeting. The island was then owned by the wealthiest families who would vacation there in the winter. They built an opulent clubhouse to host the parties for these wealthy families. It was known as the Jekyll Island Club. Some families built private homes around the island. They referred to these private homes as cottages. Munsey's magazine described the Jekyll Island Club in 1904 as the richest, most exclusive, most inaccessible club in the world. Of course it was inaccessible. It was an island and became the playground for the uber wealthy of the world. Those present at this secret meeting were Senator Nelson W. Aldrich, a powerful senator from New York and chairman of the National Monetary Commission, whose stated purpose was to reform the banking system. He was a business associate of J.P. Morgan and father-in-law of John D. Rockefeller, Jr. In other words, John D. Rockefeller's son married Aldrich's daughter. Also, A.P. Andrew, Assistant Secretary of the Treasury. Frank Vanderlip, President of the National City Bank of New York, one of the largest banks in the United States. Henry P. Davison, Senior Partner of the J.P. Morgan Company. Charles D. Norton, President of the First National Bank of New York. Benjamin Strong, head of J.P. Morgan's Trust Company, who eventually became the first chairman of the Federal Reserve System. And most importantly, Paul Warburg, the most prominent of all those present. Warburg represented the Rothschild banking dynasty in England. His brother, Max Warburg, was the head of the Warburg Banking Consortium in Germany and the Netherlands, and was also one of the wealthiest men in the world. J.P. Morgan was a member of the Jekyll Island Club. His interests and the interests of the Rockefeller and Rothschild families were certainly represented at that meeting. If the efforts of this group were successful, the Rothschild family would once again, directly or indirectly, control the banking and monetary system in the United States. Who was J.P. Morgan in 1910? Morgan had spearheaded the formation of many multinational corporations, including U.S. Steel Corporation and General Electric, with controlling interest in AT&T, Western Union, and 24 railroads. He funded and built the Titanic. He was actually booked on the maiden voyage of the Titanic, but mysteriously canceled the day before it was launched in April 1912. We will get to that story later. It all began when Nelson Aldrich sent his private rail car to the New Jersey Railroad station. In 1910, a sign of wealth was to have one's own rail car, luxuriously appointed, of course. Today's equivalent would be a private Gulfstream jet. Aldrich and 6 other men would board and be taken to Jekyll Island in absolute secrecy. They were to come separately, so it would appear they were not associated with each other. They were told to only refer to each other by their first names. The journey from New Jersey to Brunswick, Georgia took 1 day and 2 nights. Then they boarded a private boat which took them to the island and the clubhouse where they would spend the next 9 days. The purpose of this secret meeting was to restructure the way money was created in the United States and establish the Federal Reserve System. Of course, their plan included ways for them to enhance their own fortunes. They laid out a blueprint that was used for drafting the legislation for the Federal Reserve Act of 1913 that was eventually passed by Congress. Think about it. These men were intense competitors, and here they were meeting in a room to work together to change the banking system for their own self-interest. They were actually opposed to competition. This is how they typically worked. They would drive their competitors out of business if possible. If not, they would buy them out. If neither of those were possible, they would join with them in some sort of collective effort to achieve their common goal of maximizing profits. This, by definition, is called a cartel. In this case, it was a banking cartel. This is exactly what they wanted. This is how the world of the elites works, both then and now. If they could eliminate their competition, they could fix prices and expand their profit margins. Their companies were too big and powerful to be driven out of business, and none of them were willing to be acquired. So the only remaining option was to create some form of joint venture, a monopoly, if you will. David Rockefeller described his view of his family's goals this way. This is from his book, David Rockefeller Memoirs. Some even believe we, the Rockefeller family, are part of a secret cabal working against the best interest of the United States, characterizing my family and me as internationalists and of conspiring with others around the world to build a more integrated global political and economic structure. One world, if you will. If that's the charge, I stand guilty, and I am proud of it. David Rockefeller. The Federal Reserve Bank is a private banking system owned by its member banks, not part of the federal government. The Rothschild family was a central player in the design of the legislation to remake the U.S. banking and monetary system. This chart explains what the power structure looked like. They exerted their control through their emissary, Paul Warburg. Others who benefited were the Rockefeller and Morgan families. The outcome of this secret meeting was the creation and perpetuity of this banking cartel. Again, back to money and power. Those not part of this exclusive club got stuck with inflation and debt. The way this got sold to Congress was to put a name on it that sounded substantial, with the appearance of ties to and controls established by the federal government. Well, who could object to that? They convinced the politicians that if they would pass the Federal Reserve Act, a system would be in place to oversee monetary policy and to provide economic stability and economic prosperity in the United States. Again, who could object to that? There were numerous bank failures from 1890 to 1910. Most lost their savings in banks that collapsed when there was a run on bank deposits. So timing was ideal in 1913 to introduce this legislation, as long as they could package it with the right sounding words that few would object to. You might ask, who opposed this system? Well, those that did not owe their fortunes to private banks. Let's move ahead from this secret meeting in 1910 on Jekyll Island to April 1912. This takes us to the Titanic. The Titanic was the largest and most luxurious ship of its day. Its maiden voyage had many of the world's elites and powerful people on board. It is curious to note that there were no prominent bankers on board. even though they were considered as part of the world's elite. However, invited on the trip were the wealthy businessmen who happened to be opposed to the Federal Reserve Act, but who did not owe their fortunes to banking, like John Jacob Astor IV, one of the wealthiest men in the world, wealthy businessman Benjamin Guggenheim, and Isidor Straus, owner of Macy's department store. The only banker scheduled to take the trip was J.P. Morgan, who decided to back out at the last minute and who was aligned with the other bankers who attended the clandestine meeting on Jekyll Island 1.5 years before to draft the blueprint for the Federal Reserve Act legislation. None of those 7 men or anyone with ties to the Rothschild dynasty were on board. You see, the Federal Reserve Act was to be presented to Congress the following year, 1913, by these 7 prominent bankers. Some curious details about the Titanic. There were only 20 lifeboats on board, although it was designed to carry 64. The lifeboats were only able to carry about half of the passengers and crew to safety. The others went down with the Titanic, including the influential businessmen who were opposed to the formation of the Federal Reserve Bank. Another curious detail is that the emergency preparedness training that was scheduled for the morning of April 14, the day it hit the iceberg, was canceled at the last minute by Captain Smith. He felt that the ship was virtually impenetrable and unsinkable, so there was no need for such training, so he said. No red flares were on board to signal potential danger to any passing boats for rescue. Only white flares that signaled a party, indicating that everything was okay. I'm not saying that there was a conspiracy to sink the Titanic. No specific evidence supports that theory, at least none that I could find. But I can't help but notice who was on board and who was not on board. The following year, the Federal Reserve Act was passed in the Senate with 43 yes votes, 43, and 25 no votes. In the 1913 Congress, these bankers and their allies in Congress knew that they did not have enough votes to pass the Federal Reserve Act, so they arranged to have it come to a vote on December 23rd, after the senators who opposed the legislation had left on Christmas break. There were enough senators present for a quorum, and they had just enough votes to pass the legislation. G. Edward Griffin notes that these influential bankers made a trip to Washington, D.C., which they had not previously done, and implied that they provided financial incentives to ensure that the act was passed into law. The act provided that the founding families would benefit by the formation of the Federal Reserve System, and that stock in this bank or system could never be bought or sold on any exchange in the world. I do not know how the bank's stock was originally issued or how it got changed over the years as the ownership of these banks changed. G. Edward Griffin says that the stock was placed in the private foundations of these families. This provided them with the highest level of secrecy and control. Multiple sources verify that the Rothschild family still has strong control over the U.S. banking system. Today, the same Federal Reserve has flooded the market. This is today, the last few years, has flooded the market with $9 trillion of new digital currency with nothing behind it. So I think of the 9 trillion, over 8 trillion of that occurred since 2008. We're now adding debt at the Treasury at the rate of about 3 trillion a year, And just in the last couple of years, the average amount of money issued or borrowed is around 5,000 per year. So 5 trillion per year. So that is about 10 trillion from both the Treasury side and the Federal Reserve side. Nothing behind it. We are being taxed by the devaluation of our currency. We never write a check for that tax, but the devaluation of our currency is a hidden tax. Meanwhile, the world's elites are getting even richer. I'm not talking about the new money people, but those who control the old money system. All of that started in late November 1910. So these are, I've listed these before, I'll say them, so people have commented they really like these, and I'll just say them briefly because I think they're so appropriate. Watch out for buy and hold portfolios, which most of the world uses for investing. Pay off as much debt as possible, at least consumer debt. Accumulate some silver. If you don't own some, start to buy some. Real estate. It's more of a climate for selling and not yet a climate for buying. As much as possible, secure your job and income, and if possible, maybe get a side job to help ensure that income. Things may be changing. Have a food and fuel backup plan. One viewer commented, what about water? I would add water to that also. I have a backup plan for water, and I don't think of that much, but yeah, you need water and fuel and food. Grow your own food if possible, and if not, participate in a community food share arrangement, a co-op, or buy organic food at the farmer's market. Money in the bank. Think about how much money you want in the banking system and how much money you might want to take out of the banking system and hold as physical cash. Now I'm going to jump over to the stock market. So I'm going to cover the indexes both in the U.S. and the foreign markets, and I'm also going to cover bonds. So stocks, bonds from different perspectives. And this is as of Friday, and these are different indexes and stocks, and I look at this from kind of a year-to-date perspective. So through Friday, the Dow Jones Industrials were down 13% as of Friday. S&P 500 down 18%. And I think as of Monday, that's now gone over 20. TLT, which is the 20-year Treasury bond ETF, 23%, and again, down significantly on Monday. So this may be, I'm thinking, around 26% negative for the year. And I put a box around it. Where is the protection of bonds? This is not the only one. It could be the intermediate term bond, or it could be the corporate bonds, or it could be high yield bonds, could be a lot of things. They're all down. No protection against stocks. NASDAQ 100 down 27%. And again, I think that's now over 30 as of Monday. The technology sector of the NASDAQ 100 index down 31% and probably 34 or 35% as of Monday. The ARK-K funds, the innovation funds, down 57, and Netflix down 69. I see a lot of people's portfolios, and the ones I see, people tend to be down 20 to 30% typically. It's rare to see anything under 20% negative for the year. 20 to 30 is common, and I definitely am aware of ones that are over 30% negative. Someone wrote me a comment last week that, well, I won't even say the number. It was just ridiculously high, a lot of loss, and who did not know what to do. I put this dashboard together of the indexes, U.S., foreign, and again, I've got Netflix, Coinbase, etc. So I wanted to put gold and silver. It was commented, hey, I ought to show gold and silver on here. Okay, I'll do that. I'll cover that later. So year to date, gold is positive. The only thing on this chart that's positive is gold by 2%, silver negative by 6%. And you can see these indexes, and you go on from there, the Dow, emerging markets, S&P 500, developed markets, small cap Russell 2000, NASDAQ 100, Netflix, and Coinbase. All of them are below their 20, 50, 100, and 200-day moving averages, except gold, which is above 2 of them, and silver, which is above 1 of them. Every single one is negative. That compares to, I think it was 9 last week that were green. This breaks down the sectors, and in the S&P 500 there are 11 sectors. And so I take those 11 sectors and put them on and I look at their index, and are they above or below their 20, 50, 100, and 200-day moving averages. All of the sectors of the S&P 500 as of Friday were below all 4 of the moving averages except energy, XLE, representing the energy sector, which is primarily oil, all below. I'm going to look at some charts. These are line charts, and these are weekly charts. This is a weekly chart of a 12-month period of time for the S&P 500 measured by the exchange traded fund SPY. And you can see for approximately the last 6 months that the S&P 500 index SPY has been in a period of decline. And the 6 months approximately before that, a period that was rising. So the S&P 500 for the last 12 months tells 2 very different stories, a rising market and a falling market. And then I cut through that with a 20-period moving average. So you can see how far it is below its 20-period moving average. The S&P 500 is broken down into growth stocks. It's broken into sectors, number one. But secondly, all of that is also broken into growth stocks or value stocks. Value stocks tend to be those that are more focused on profit. Yes, they want growth, but they primarily want profit. Growth stocks, that's value. Growth stocks tend to be the opposite. They tend to focus on growth and revenue, and with some degree of emphasis on profitability, but they're more focused on growing revenue. So when I put that into an equation, numerator growth, value denominator, it creates a ratio. And this chart plots that ratio so you can see the degree of dominance of growth versus value. So if the chart is going up, which it did for the left side of the chart, that shows that growth was in favor over value. In the second part of the chart, represented by the black line, or black arrow, you can see that the S&P 500, the growth stocks were out of favor and the value stocks were in favor. So that's how much the degree of being out of favor those growth stocks were, conversely, how much in favor the value stocks were. They all declined, it's just that value declined less. When I chart small cap stocks represented by IWM, the Russell 2000 against SPY, IWM numerator, SPY denominator, 12-month weekly chart, we see that again for the last year, it's been in a period of decline. I put a circle at the end of it. This is as of Friday. Is that now, relatively speaking, they're both down, but small cap is down less. Are they now in a period where small cap is going to start to emerge and become more, grow more, the index be more in favor than S&P? It kind of looks like it, but I don't know that for sure. I take the 12-month chart and I push it out to a 24-month chart. And now I put on the government long-term government bond, and represented by the ETF TLT, and I plot that. This is not a relative chart. This is an absolute chart. Just looking at TLT, you can see in the left side of the chart, the red arrow pointing down, the degree of decline of the long-term government bond. And then it tried to go back up. And then over the last 6-7 months, collapsed, still collapsing. Even Monday collapsed even more, quite a bit. So it is in a period of decline. What's interesting about this is that this is the long-term government bond. So a lot of, some financial advisors use this as a antidote for stock risk. Some others use maybe the 10-year government bond. Maybe it's even possible to use the short-term government bond. But somehow, some kind of a protection against equity risk. And they could use corporate bonds. But this shows the one that has historically provided the most protection against equities. They're all in this direction. It's just that the long-term government bond has dropped percentage-wise even more. But the general direction is similar for the intermediate and short-term bonds. So the model of, why I said earlier, watch out for buy and hold portfolios, because this or bonds like this are in buy and hold portfolios a lot. And you can see where it's going. It has been horrible. And traditional financial advisors, investors, they don't know what to do. They've been buying the story for 40 years that bonds are a protection against stocks. But when the yield on bonds and interest rates, which are correlated, when those hit the bottom down to zero, we all knew, everybody knew, they had nowhere to go but up. And when interest rates and bond yields go up, bond prices go down. Everybody knows that. So why didn't the traditional financial advisors do something about it? Because they're not taught to think that way. They're taught that you just have bonds in your portfolio, and over time, they're going to come back. They're going to be the protection eventually. They've got all these lines memorized, but you're the one that pays the price for it if you're in a buy and hold or 60-40 type of portfolio. Gold. Gold has generally gone up and down a lot. So I look for patterns. And this has got several different patterns in it. So I see the upward trend pattern represented by the black arrow, and then another little pattern at the very end, which I circled. So kind of going up in both ways. And then I put a red arrow at the end, but there is also a pattern here where it's down for the last few months. It's been down from where it was back in February, March. So a lot of up and down. And that's a 24-month chart. Silver, similar, but not as much up. It's more has a downward direction to it. And then I put the 20-period moving average, kind of cuts through all of that, so you can see where it is relative to its 20-period moving average. And then I plot this is a relative chart. This is not absolute, still a 24-month chart. So I'm putting silver as the numerator, gold as the denominator. So when it goes up, silver's in favor, and when it goes down, gold is in favor. So you can see, really, silver is in favor quite a bit for a period, and then it changed. So that's That's where it is. And then I put the volatility index, the volatility of the market, is generally increasing. And what that means is it's a measure of risk, and it's a measure of volatility, negative volatility. So when it goes up, then that means that volatility, negative volatility, is entering the market. So an upward trend on this is not good news for being in the market. I put it's an arbitrary number. I put a line at 24 because it's thought by many people that if this index is above 24, it's generally a higher risk market. And if it's below 24, particularly if it's declining at below 24, it is generally risk is starting to come out of the market. So you can see the general direction is up. And if I added Monday to this, it would probably be up even more. Asbury Research does indicators. This is their the metrics of their Asbury 6, and I won't go through the detail of these, but you know there are different ways of looking at the market and risk in the market. They have 5 out of their 6 which are negative and became negative as of Friday. So only 1 is positive. That is kind of a bearish looking set of metrics. This is interesting because this does not indicate whether things are up or down. This is a relative performance among different types of assets. Asbury calls it their cross-asset relative performance chart. And when it's green, it means it's a dominant relativity. And both could be going up, but one would be going up more than the other. Or both could be going down, and one is going down less than the other. Or they could be going in different directions. But when looked at with U.S. stocks or bonds, as bad as stocks are, or excuse me, as bad as bonds are, stocks are worse. So what is in favor? Bonds are in favor, even though they have fallen a lot. High volatility or low volatility? Low volatility is stocks are better. Large cap or small cap? Small cap, as we saw earlier, is starting to do better. S&P 500 broad market versus the Dow, which is the blue chips. The Dow clearly, you saw from the previous chart, clearly is doing better than the S&P 500. And the S&P 500 versus the NASDAQ, clearly the S&P 500 is doing better. Again, we saw that on a previous chart. Value versus growth. Here we have it again. Value's doing better. Not going up, just going down less. And U.S. or emerging markets are starting to do better than, definitely better than the U.S. So think about this. These are foreign markets. They are emerging markets or emerging economies, and they're doing better. In some cases, a lot better than the U.S. Interesting. Government bonds, in the last section, government bonds are doing better than corporate bonds. You saw how bad government bonds are doing, but they're doing better than corporate bonds. High yield or corporate bonds are doing better than high yield. So in this mixture of government, corporate, and high yield, the worst is high yield, and the best of the worst is government. And short-term versus long-term. Short-term is down, but it's down less than long-term. U.S. versus the world. There are some countries here. This is 21 countries and 3 regions of the world. So all those countries and regions are measured against the U.S. from a performance standpoint of their exchange-traded funds. There's an ETF for each of those countries that can be traded. And ours is SPY. We use SPY as the general benchmark or indicator for the U.S. So when SPY is measured against each of these, none of the cases is the U.S. significantly better on a weekly, the last week, the last month, or the last quarter. None. Some, the U.S. is slightly ahead, which are in white, but when it gets to green, that means dominant movement. U.S. is not on the chart. Those that are outperforming the U.S. are enough significantly in all three time periods are Hong Kong, Taiwan, China, Russia, and emerging markets. Isn't that interesting? Finally, gold and silver. Spot prices, 1854 on gold, 2196 on silver. And finally, I wanted to make an apology and a correction. I made an error, and someone mentioned it, actually two people mentioned it, and that it was an error, and so I want to correct that. This was a couple of weeks ago. I quoted Warren Buffett as saying, "Get ready to lose half your money." Actually, it was an article from Motley Fool. Actually, he did not say that. That was the title of the article, so I should have said it more correctly. And the article went on to point out the 4 different periods of time in the last 50 years where Warren Buffett did lose half his money. And the average loss of those 4 times was about 50%. Going back to 1973 to present, 4 times he lost half his money, so to speak, in Berkshire Hathaway. And so I wanted to correct that. He does warn right now against that we're in sort of a bubble, and he's being defensive. He's sitting on $144 billion in cash last time I looked, and waiting for companies to buy, and they are overvalued still, and he is not ready yet to deploy his cash. So his words of caution, his actions, all say the same thing, but I wanted to correct what I said. Thank you for watching. If you have comments or questions on anything, certainly on the Federal Reserve or my comments on the Federal Reserve, the history of it, the level of corruption and deception that occurred in the formation of the Federal Reserve, feel free to leave those comments. I'll try to respond to as many as I can. And thank you for watching.